We're still focusing on funds and their performance over the first half of the year, and it's time now to delve into the top performing funds. Take a look at which managers were able to deliver for the first half of the year. So David, I suppose let's get a broad view from you in terms of the key standout themes that we're looking at for the first half of the year. To what extent was the performance guided by market performance when we're just looking at the key sectors that we have been talking about so far?
Yeah, so when we take a look at these numbers, you can see the top performing funds here. Two of them are property funds. If you had sort of scaled down that list further and seen the top 10, most of the other funds in that list were also property funds. And what we saw in the numbers was that listed property was leading the way, and that's not a surprise. I think sort of the standout in this from the top performing funds is that Ned Group Investments Entrepreneur Fund, which is more of a small mid-cap domestic equity focus, and so despite it wasn't the top sort of performing asset class, the manager happened to do well. Well,
certainly is a standout there. And before we get into that and why they stood out, what they're doing right in this market environment, Kobe, let's roll those drums and see who came out top for this half.
Let's have a look at who were the top performing managers. And again, what we've done here is we've looked at returns year to date. So just to kind of give it a 6-month kind of flair rather than the quarter, because the quarter is a really short period of time. Look at the table on your screen at the moment, and there you can see it. There's the BJA multi-manager property portfolio fund, which gained 20.3% year to date. Sesfikile SCI, the property fund, up 20.3%. And then the outlier, obviously, is Net Group Investments, the Entrepreneur Fund, which is up 19.6%. That's Anthony Sedgwick's fund from ABAX Fund Managers. That's obviously a business which was started by Tim Alsop a couple of years ago. But you can see the property theme there. You can see how the property theme continues to come through. And as a matter of fact, I always am so surprised on how little news there is about the property industry at the moment. You know, there's just good news. There's not much in light of bad news. Sesfikile, by the way, is run by Evan Jankovic, which is kind of a small boutique fund management operation, kind of focusing on the property space. And the three managers in that multi-manager, that BJA multi-manager space, is both RMB, Sesfikile, and Stanhope. And I said we were going to look at longer-term numbers. Look at the graph that we've got on the screen at the moment, and there you'll see what listed property has done for the decade. So let's assume you put in 100 Rand in listed property right at the beginning of the decade. Well, for every 100 Rand, you'd probably be worth 1,000 Rand now. And look what has happened to dividend yields over the period. That's the light blue line. You can see how that has literally just reduced and reduced up to the point where we are now. Amazing to see that in the beginning of the decade, you could have locked in property returns at 16% yields. No longer the case at the moment. To kind of just indicate what has happened in that space.
So there we go. Anthony Sedgwick's fund, clearly a standout. That's the Nedbank Entrepreneur Fund, a 19.6% return. David, what has Anthony managed to get right for this half of the year in terms of being an equity fund and in light of the performance that we've seen from other equity funds?
Quite a lot, actually. There aren't too many places that he sort of misstepped over the quarter. And again, I think as Kobe pointed out, a quarter is a real short period of time to sort of distinguish things. But ABAX does have looks like an impressive longer-term track record. But very specifically, the fund was the biggest contributor was an overweight to consumer discretionary, which was the best sort of. I'm looking at sort of more year-to-date here, but an overweight to consumer discretionary really helped the fund over that period of time. Also, particular names, so like Mr. Price was one of the leading contributors to the fund's performance. So these are sort of a little more economically sensitive names that have done well over that period with with the greater sort of South African market.
So the right stock picking really has helped him out. Is that a lesson, Roland, that we need to take from this? Mr. Price, he got it right.
Absolutely. I would. The word small cap was mentioned. Mr. Price isn't that much of a small cap stock
certainly
anymore.
Not anymore.
And it certainly isn't a value stock either anymore, but clearly the fund manager chose that stock and it did well, so good for them.
Yeah.
Let's maybe look, let's maybe just shift our attention. Let's go look at maybe those kind of the worst performing categories for year to date. Look at the table on your screen at the moment, and you'll see, there you can see the worst performing funds over kind of year to date. There you can see the Stand-Up Gold and Precious Metals Fund. That's a fund run by Herman van Veltzer at Stand-Up. The Old Mutual Gold Fund down minus 13% over the period. That's Ian Woodley's fund. And then Byron Ritter's fund at Sanlam Resources down minus 9.9. And then you can see some of the star ratings for Morningstar. Remember that the star ratings, if you want to know more about the star ratings, go and watch the show on the blog in order just to understand a little bit more about how that star rating for Morningstar in essence works. Let's just maybe take the decade-long view as well on each one of these asset classes. And there you can see 3 lines on your screen at the moment. The red line indicates the resources index. You can see the major sharp decline in resources and where resources have kind of ended for this year relative to gold price in rands, relative to gold price in dollars. And you can see kind of where those two have ended during the period.
Yeah, I mean, it's, David was saying, just feeling fatigued right now. It's been 5 years. The economy, the global economy, has still not been able to get itself out of the problems that we're sitting with right now. So, David, when we're looking at the worst performing funds right now, if someone had to have their money in them, they're certainly not happy at this point in time. Just looking at the year-to-date performance, certainly not happy if you had your money in resources over the longer period since the financial crisis and everything. Is it time to be running for the hills? Time to be moving into the other funds that we saw as the best performing funds, or what type of theme or lesson can we extrapolate from this?
Funny enough, I think one of the most consistent things I've witnessed in my time is that investors make very poor timing decisions, and they sell high and they buy high and sell low. So I think if you're at that point where the fund's been underperforming or that general area has been underperforming for a long enough time, and you feel like you're getting ready to capitulate, that's probably when you don't want to do it. Act against your better judgment if you can. And it sounds kind of maybe contrite or silly, but it really is the sort of the psychological fear and greed really does come into play. And that's a big part of what you're paying a professional money manager to do. I personally don't think stock investing is rocket science, but it takes somebody to be very disciplined, systematic. I mean, certainly these are intelligent people. There's no doubt about it. But it's far more. I think successful investment management is a lot to do with discipline.
Yeah, and someone who's not going to take a hot-headed decision because it's not actually their direct money. Perhaps, obviously, they're earning money off your money. But Roland, when we're talking about exposure to equities and looking at some of these funds, the ones that have been hard hit are the resources sectors, and they're very kind of concentrated funds. They're very exposed to certain precious metals.
These are specialist funds, and nobody suggests, even the fund managers I think would suggest you should put all your money with a dedicated resource fund or a dedicated property fund, which is at the top of the ranking. So it's all about choosing maybe a bundle of funds or a balanced fund which tries to sort of circumvent that at asset class level. But you should, as we all know, look at diversification quite closely. And if anybody over 10 years has all their money in a resource fund, will probably be quite surprised about the end result there. But maybe I can just ask David about Kirby's going to look at the domestic fund flows, but have you seen any trends globally on the fund flows in terms of asset classes or countries or sectors?
Yeah, I mean, it sounds very obvious, but and it is. It's very predictable. Money is coming out of risky assets and going into more conservative assets. So bond funds and even money market funds globally have been attracting a lot of inflows. Money's coming out of Europe, out of the United States. We'd seen quite a bit of money going into the emerging markets earlier in the year. I think that's probably curtailed a little bit, but the general theme is out of anything economically sensitive and anything perceived as risky, and trying to find safe haven places to hide.
So how's this translated into the local fund environment?
Yeah, I mean, have a look at the table that's on your screen, and you'll see kind of the domestic fund flows. And again, what Roland said just now, there 11.8 billion rand flowing into domestic asset allocation, the variable equity funds. That means the fund manager has the ability to actually swap around and switch around on the asset allocation for a specific objective. Domestic fixed income, varied specialists as well, 8.49 billion. And domestic asset allocation, low equity, very scared about markets. That's what that basically tells you. People being concerned, continue to be very, very conservative about exactly how they and where they, and trying to kind of kind of mothball capital. The other thing to watch is kind of where that money has come from. Look at that table that we've got for you at the moment, and you'll see where the capital's come from. Domestic equity, value. These are sold value fund managers, domestic equity general, and then equity resources and basic industrials. And invariably, that's where kind of valuation sits. That's where you're going to get your best valuations.
Yeah, so David, closing comment as we, of course, are now firmly into second half of the year. What can we learn from the first half of 2012?
Well, I mean, I would say right now, if I am looking to sort of, I mean, I think Roland's point is correct. I mean, you need to have a diversified portfolio based on your risk tolerance and time horizon and all that. If you do want to sort of explore at the sort of edges of your portfolio and put a little bit more into a certain asset class, I mean, look where all the negative news is, look where all the negative sentiment is, and that's probably where your best opportunities are. I mean, it sounds very simple, but it's, for the most part, a pretty good rule of thumb. I mean, I don't know too many people who aren't talking about how horrible things are in Europe and the collapse of the Eurozone and the Greece leaving the currency and all the negative implications. And same thing with economically sensitive assets and businesses. There's not a whole lot of positive sentiment around those. So, you know, I might be looking at that area to put a little bit of extra weight in my portfolio.